All right, let's start this module, this Accounting 1 module, with accountable plans. They really should be our first lesson. They are extremely important to the S corporation setup, and really they don't get nearly as much attention as they should. I'm surprised we don't hear more about accountable plans because they are really one of the only ways to get automobile expenses if the owner of an S corporation has an automobile in their personal name. It's really the only way to get it in there. I'm surprised it's not a huge deal. I will also say that accountable plans are probably the biggest drawback to S corporations in doing all of this. Because if you were a sole proprietorship, this would be easier because your personal assets are connected to your personal tax return. So when we created this S corporation, we now created this need for accountable plans, and that's no fun. So we do need to recognize that accountable plans are kind of a pain, and we need to understand our clients' pain that they feel with having to do these. But by no means does it offset this idea of, well, instead of doing accountable plans, let's just pay self-employment tax. That's a terrible idea. So we need to show them that in every other way, the sole proprietorships are bad, and S corporations are great despite this accountable plan thing. So it doesn't change my feelings about S corps. It's just kind of a pain in the butt that we have to do. So I'm going to make a big deal about them through this lesson because I'm going to show you how, if you're not doing accountable plans for all these S corporation owners, you're going to kind of have a problem if later on down the road the IRS or anybody wants to poke around in this thing. So get ready, because this is something that if you're not doing right now and you're not familiar with it, you're going to have to start doing. Let's jump into it. So the first thing to know about these are they're really all they are is an expense report. You know what I mean? That's really all it is. We're calling it an accountable plan. It sounds fancy, but it is the S corporation owner needs to submit an expense report to the company to be reimbursed for personal expenses. Because the business is an S corporation, your owners are also employees of the company. They have to submit these expense reports at least quarterly. Really, the IRS documents say they need to be submitted at least every 60 days, but you can create a plan document that does it quarterly. And case law, meaning when the IRS goes in and takes a look at these, they've been accepting quarterly. So we can use some of that case law to say our clients can accept quarterly. They have to submit these expense reports for anything they want to deduct from their personal life. Okay, the S corporation, if it does not own the asset or pay for these items that are in your personal life, it can't deduct them unless the employee submits an expense report. So that's really all we're getting at. What do these include? It includes things like car expenses. Probably the number one thing that it kind of triggers our requirement to do these expense reports are automobile expenses. And I'll go into this later, but if your client doesn't want to deduct a car, you may not need to do accountable plans at all, which great, so be it. But things like car expenses, home office, cell phone, other expenses that are paid for through personal funds. The main reason we need them, as I said, is this car and the home office. There's no other way to get the car expenses into the return if the car is owned by the employee, okay, or by the owner employee. When I say employee in this lesson, it means the owner, because the owner is also an employee of the corporation. Also, and here's why home office is big, you have to establish a home office if you want most of your car expenses to count as something other than the commute. So let's say that you don't establish a home office, and when you commute to the office back and forth, that's really all the driving you're doing for your business each day. That's definitely how my business is. I drive to my office from my house and then I drive home. I don't drive out to a lot of clients. Well, if I don't establish a home office, I do not get to deduct and count that commute back and forth as business related, which means I wouldn't deduct the car at all. So we're not establishing the home office because it's a big deduction. It's not. It's usually frivolous money. The reason we're establishing the home office is so that we can establish that when we wake up in the morning, we're at the office, and when we go to another place to conduct work, that's almost a second office. And thus that commute is business related because I do not, the only reason I'm going to that other office is to conduct business. Does that make sense? There's no more commute. So both are really, really important to these accountable plans. I'm going to go into more of that here in a bit. But first, let's kind of dive into what is the difference between an accountable plan and a non-accountable plan. So accountable versus non-accountable. The first thing I'm going to tell you is a non-accountable plan is bad, right? And I'm going to show you why. It means that if you don't follow the rules of an accountable plan, then you have a non-accountable plan. And that means that it's all taxable. And by taxable, it means whenever the business gets your expense report, it writes off the expenses, but when it reimburses the employee has to pay tax on it. That's a non-accountable plan, which is bad. There's almost no reason to do it. If the employee's going to have to pay tax on it, why deduct it through the business? You didn't get any benefit for it. On an accountable plan, the cool part about this is when you submit those expenses to the corporation's going to deduct them, but you do not have to take them as income in any way. So we want to make sure our plans are accountable plans. To be accountable plans, there are three rules. So follow these rules. First, the expenses must have a business purpose. So going to the movies doesn't work, nor does the cost of your kids' summer camp. This is kind of an easy one, right? It's got to be connected with the business. And we have a very good instinct for what is business related. So that's the first rule. Second, you have to turn in to the business your expense reports with receipts, or at least have them available if they need them. It's called substantiating the expenses. There's apps that can help you do this. You can do it once a month, you can do it once a quarter, but your client has to have a way with like receipts and mileage logs that they're tracking and they can prove what they spent money on. And as you can imagine, when it comes to the substantiation, the mileage log is probably the most important. And there's several apps for mileage tracking, right? But they need to use something so that they can track all of this driving that they're going to do. And any other expenses, they need receipts and be able to prove it. And they need to turn in those receipts and those logs with this expense report, okay? Finally, and the third piece is, there must be a mechanism for returning overpayments. So this is if you provide employee advances, okay, before they've spent the money, even yourself. Then if you accidentally overpaid because you're guessing at what the advance needs to be and you overpaid them based on the expense reports they turned in, there has to be a mechanism where they return that money. They don't just keep it, okay? And they have to return that money in a certain time frame, no more than 120 days after the expense occurred. So they incurred an expense on January 5th and turned in an expense report on April 5th, let's say, then they really need to, in the next 30 days, reimburse the company for whatever they were overpaid, because that would be within that 120 days when the expense occurred. So most of the time I do not allow my S corporations to do any kind of advances to where we're not getting into this kind of thing. Instead, I'm just holding their feet to the fire on quarterly expense reports, and then we're reimbursing them for whatever they spent their money on. So in order to make sure we always have an accountable plan and we don't start, kind of leaning into the non-accountable plan world, we have to have a written document for our clients, okay, that they're going to sign off on. And I'm going to show you an example that I've included in the lesson here of what our clients use and sign. So let me pull that up here real quick. Okay, so here is what we use at my firm, and I don't even really know where we got it. A long time ago. I don't know that we made it ourselves or not, but I've checked it, and we know that it works very well, and it covers everything that you need to cover in an accountable plan. And it's really simple to fill out. Really, the client just has to put in the name here, and you can do this for them. And then it kind of just goes through all of these requirements that the IRS has that you're going to follow the rules. Then if there are any exceptions that they want to make to this plan, they can fill that out, which we never have, but in case there are any, there's a place for this. And then the company officer prints and signs their name and keep it. And this isn't something that you have to keep as the accountant. You can, because we know clients lose stuff, right? It's really something that they have to keep. So if the IRS ever does come in and say, hey, we want to take a look at that accountable plan document, it's there and it's signed and it's kind of in, some kind of file management system. So if you want to have the client sign this, we provide these to our clients as part of the onboarding process. That you remember from onboarding, there is an email that goes out that has this template in it, and we say fill this out if you're doing your own accountable plan. If you're hiring us to do it, which I'm going to get into here in a little bit, we make sure that they fill it out and we keep it, and we kind of move on. So this is the plan document that has to be filled out that everybody should at the very least get. If they're not going to pay you to manage this, then you probably don't care too much what they do with it after that. But if they are going to pay you to manage their accountable plan, then we'll have to facilitate making sure this gets filled out. Make sense? So let's move over now to the second document, which is the expense report. So here's the expense report. I've also got this included in the materials, and this is what we provide our clients at Reagan Financial. I've changed the colors here a little bit to be purple because it's Halon. You can go in here and change all of this if you want to. You can put your logo up here if you want to, whatever you want to do. But here's kind of the way that it works. It looks like any other expense report. They put in the business name here, and we just have accountable plan up at the top. And once a year, even once every 10 years, if they don't sell their house very often or move houses very often, they put in what the amount of their square footage in their office is and their total square footage, and we get this business use percentage. And a lot of these things calculate on their own. So if you've got something that is calculating here on its own, don't, and I shaded this one on purpose just to kind of show you what not to do, don't have this be shaded in. So only have the things that clients are supposed to fill out shaded, and then anything like this where it's not shaded. Here, let me change this to no fill. When it's not shaded, you need to lock this down. And if you're not sure how to lock down a spreadsheet, I've left all the calculations open in case you want to change them. If you don't know how to lock down a spreadsheet, just Google it online. It's really easy, and you can lock down everything other than these gray boxes that they fill in. Okay, so we figure out their business use percentage of their home. It's the first thing we do because we're establishing their home office. We come then to the full year home expenses, which is rent and mortgage and all of these things that you can put in for the total year. None of this stuff is going to change that much. Utilities, if we know what they are each quarter, we can put those in here, however you want to manage it. But you're going to come up with what the total kind of fixed home expenses are. And then you're going to get a deductible portion of those expenses. You may want to move utilities down here under variable. If you want to, go right ahead. We typically have our clients give us some idea of what they think it's going to be. We have them lowball it a little bit and put this in here. It's one less thing to track, which is what I'm going to get into here in a little bit. As you can see, the deduction is never very much. So the only reason we're doing this is to establish this home office for commuting purposes. We then come in with the variable home expenses, repairs of any kind to their home, cleaning of the home, lawn care, any other costs that are variable to the home. Here, what we're doing is we're filling in the total amount of the variable costs, and then we are also putting in the deductible portion of those variable expenses, because this deductible piece is being multiplied against all the way up here, this 8%. Does that make sense? So again, they don't get a lot. And so when we add the 41 and the 142, we get total home office expenses a year of, in this case, $183. It'd probably be more when you put in your rent or your mortgage interest and things. But again, it's going to be like $1,000 or $2,000, and it's not a huge amount. This is the quarterly amount though, and so it's 25% of the full year plus the variable cost for the quarter, and you get this total. Now we get into the stuff that is quite a bit more important, which is the automobile expenses. And I recommend my clients get an app to where they can tell me what their business miles were each quarter and then what the total amount of miles driven on their car were. And we get this business use percentage of their car. That makes sense? Then we have a couple of different options when it comes to deducting automobile expenses. The first is the mileage method, which allows for like 54 cents, 54 and a half cents. You can see how right here in the equation, 0.545, 54 and a half cents per mile, or they can use their actual expenses. This would be automobile loan interest if they own the car, the depreciation if they own the car, the vehicle lease payment if they're leasing the car, then fuel, registration. You want to have them fill out all of this. Okay, you want to have them fill out everything because this is going to choose whatever is more. There is a little bit of a hiccup here where if you in the first year that they've owned the car, they own the car and they take depreciation and all that bonus depreciation, because in the first year of owning a car there's all this bonus depreciation, which you're going to learn about in the depreciation module of Accounting 1. But if they choose that in the first year, they have to stick with it. They can't then convert to mileage the second year. And the reason is because you could take advantage of the system, right? You got this massive depreciation deduction in the first year, and then you started taking mileage every year after that, and you could end up expensing more than what the car really, is worth, even though you could do that with business miles no matter what. Either way, make sure they fill this in. We will go over depreciation and everything like that in the depreciation module. Just know that for putting in the depreciation of the car right here, I have a calculator you're going to use for that's on the Halon website, where you can calculate depreciation for any asset you want to and fill this in. If they're not paying you to do this, you can help them find it, or they can find it on their own. Again, I'm going to get into that here in a couple of slides, but we're going to fill in all this car information, and we're going to get what the quarterly automobile deduction should be. Then we're going to get into our office expenses. So we've got internet and cell phone costs and other costs, and we're going to find out what that is. Notice how I say 80% allocation. I make this equation only take 80% of what their full costs were, because I know that part of that's personal use. 80%, they probably more of their personal use is probably more like 50-50 really, but I allow them to claim 80% as a business deduction. So we're taking what they spent times 80% and saying that's the business use piece of it. Then there's this other out-of-pocket piece, which is travel costs, parking, business meals, other expenses. They get 100% of that. And then here's the total reimbursement for the quarter. This is what they must transfer from their business account to their personal account to show on the books that the company has reimbursed them for all of these costs that they have personally. This is just an expense report. Okay, don't make it more complicated than it has to be. That if they know how to fill it out themselves, and will remember to do it every quarter, have them fill it out, and they will send it to you with this amount. And if they're doing this on their own, they're responsible for doing the transfer. And then when they do the transfer, here's what happens. There's a second tab here called journal entry. When they originally transferred that money and you were doing the weekly books, or if you just wanted to move it over to shareholder distribution, because you do that every time they move money to themselves, that's fine. Then when it's time to do the work of this journal entry each quarter, this is automatically calculating these categories for you, and you're going to book it as occupancy expense and automobile or office expense and meals and travel and other, and you're going to create a journal entry that makes that work. Now listen, if you don't like journal entries and you don't want to make this entry until you know what this breakout is, that's fine too. Do it however you want to. That way you're not doing a journal entry. You're actually, when they move the money from the bank, you're booking these different expenses, and the offset isn't distribution, the offset's cash. So that's fine. But I typically just throw everything into shareholder distribution, and then when we're doing all of the accountable plans for clients and doing all these journal entries at once, we just move it from shareholder distribution and make a journal entry to do all of that. So does that make sense? This is in your lesson here as part of the materials. You can use this. Like I said, make sure you lock down the calculations if you give it to clients. Now, in the next couple of slides, I'm going to talk about home office and some automobile things, and then we're going to get back to how to actually present all this to clients. So just hold your questions for a second. I know there's probably several on this. I just wanted to go through the spreadsheet quickly and show you the actual spreadsheet that gets filled out at our firm, and then we're going to get into some of the how do you make all this happen in some later slides, okay? I'm going to move on now and chat a little bit about the home office. So home office, no doubt you have probably heard that this kind of thing is not worth tracking. You just saw in the spreadsheet, it doesn't add up to a lot. I mean, $1,000 or $2,000, and that's not $1,000 or $2,000 in tax. That is a deduction, which when you apply it times their tax rate, it may only save them $200. Now, $200 is $200, but you've probably heard that this is also kind of a bad thing from an audit perspective. In the past, it has been in what I call an audit gateway that the IRS uses to find problems and adjustments that need to be made, that kind of thing. And you know, it does happen some. If you don't try and deduct 500 square feet of a 700 square foot house, you will be fine. Okay, so just know we're not using the home office as a way to save money. We're trying to establish that our home is one of our offices, and in fact, our primary office, and we're going to use that whenever we are doing anything outside of the office. So anytime we have meals, anytime we have using our automobile, all of that is outside of our office. Thus, it is going to be business related, and we are going to maximize the value of this S corporation thing. So let me kind of give you an example here. So I have my house in Florida, but I also have a 3,000 square foot office about 15 miles away. In the absence of establishing a home office, when I drive to my other office, that is considered commute. So that does not count as business miles. Most weeks, that is the only drive that I might make, just back and forth. That means I don't get to deduct anything for my car. None. However, if I establish that my home is my office, then whenever I make that drive to my other office, that counts as a business trip. Because I left one office with zero commute, that's my house, and went to the other office. Now my driving to my office every day is deductible. Same if I need to leave my house and go to a client, that whole thing is business related too. Well, we have 2 cars in my family, one of which I'm trying to deduct for business purposes. I don't deduct my wife's car. So most of the time, my car that I have is almost 100% business related because we drive her car most of the time on the weekends and I don't use my car. So probably my car ends up with about 90% business use, and that's what I'm wanting. That way I can take a large deduction here. So if we do all of this, if we set up this home office and make sure that we are asking of our clients to put all this information into the accountable plan each quarter and doing the reimbursements and doing everything, that is how they get to deduct the automobile. And we need to make that case to them as part of the onboarding of why the accountable plan is so important. If like I said before, if your client does not care about establishing the kind of this effect, this automobile expenses, let's say they don't have a car, they live in a city and they don't go anywhere. There's lots of reasons they might not want this. Then you might not need to establish this home office thing, and you might not need accountable plan at all. If you don't need the home office and you don't need the automobile, you might not need an accountable plan at all for that client, but most of them need it. And if they like deducting automobile expenses on their personal car, you still have to do all of this. And as I've got on the slide here, that includes rent, mortgage interest, taxes, insurance, HOA, cleaning, landscape, all that kind of stuff. So everything that goes into the maintenance and maintaining and paying for the house that should go into the expense report. Let me talk a little bit about auto expenses here next. So as I kind of alluded to in the slide earlier, when it comes to auto expenses, the brutal part of all of this, the hard part, is getting your client to, and it's really the hardest part of accountable plans in general, is getting your client to track mileage. They all have to track mileage if they want to do anything automobile related. And so they're going to need to set up some kind of app to help them do it. And there's several out there. I'm not going to make a recommendation. Test the different ones out and see what you like best. They all need to be monitored for non-compliance in this. So if they're doing their own accountable plan, I'm going to show you here in the next slide how we're going to kind of monitor their non-compliance. If they are paying you, you have to make sure that when they're submitting information to you each quarter, and I'm going to show you how to do all that, that they're tracking this mileage. And if they're not doing it, you need to have kind of this talk with them. You need to have kind of this time for Big Mama or Big Daddy to sit you down, Mr. Client, and tell you, hey, if you're not going to do this, I'm not going to let you write this stuff off, okay? And you got to do this. The apps are great. They're not expensive. I don't care what clients say. They're just not expensive compared to the deduction for your automobile. And like I said, really we're only going to monitor people if they're paying us to do that. They also need to track other expenses having to do with the car. This is because they can take either the mileage rate, as I said before, or the actual expenses, whichever's higher they can take. The main thing here is fuel. They need to make sure that they're tracking fuel. And if you want to let them use the business credit card to track fuel, and then you are getting paid for this accountable plan and you move that onto their accountable plan each quarter, that's fine. Many of them will be able to track fuel whenever they do an expense report on their own. It's one of the easiest things to go on their credit card and find. Many times they kind of estimate it. Again, if they're doing it on their own, it's their deal. We're not going to try and audit it if they're not going to pay us to do it. But they need to track the car washes, anytime they get their tires changed, any kind of service appointments, any kind of repairs, all of that, okay? And sometimes it's pretty easy to know whether a client is going to be mileage or whether they're going to be actual expenses. I'm going to kind of show you how to have an idea whether a client is going to fall into one category or another. And to figure this out, you need to find out what the value of their car is, okay? And I can tell you this, that if a client that drives a car that's valued at less than $40,000, when it was new, really, or they drive more than 10,000 miles, business miles, the mileage is probably going to be the one that works well. So inexpensive cars or high business miles, it's going to be mileage that you take. Expensive car, over 40K, or not very many business miles, it's going to be actual expenses. So as you're kind of trying to figure out what kind of client this is going to be, get an idea of what their car is and what their driving is like, and that's going to give you an idea whether they're going to use the mileage most of the time or the actual expense method most of the time. And a lot of that has to do with the new depreciation rules that went into effect this year. So the really expensive cars are going to get these massive depreciation allowances, and then you're going to end up using the actual cost method versus mileage, because they're going to be able to write off these huge amounts in the first year. The best time to go over all of this, and we're going to talk about this in the next slide, the best time to go over all of this is during onboarding, or when you convert them to an S corporation. Take the time to do it and teach them about it if they pay you for your add-on. And let me jump into kind of talking about this add-on, because I'm sure by now you're like, well, I'm not doing any of this unless they pay me. And I get it. I'm going to take you through this here right now. Okay, so let's talk about how to get paid for this, because I want to make one thing really, really clear. If a client is not willing to pay you to monitor and do their accountable plan, then besides showing them that it needs to be done, and then what I'm going to show you here in a little bit about harping on them when they don't get the accountable plan to you, we're not going to care. And that includes, we're not going to allow them to write off their car or their home office or something like that without them doing it right. So if a client comes to you and isn't willing to pay the add-on for the accountable plan and comes to you and says, well, can't we just, here's my automobile expenses, just put them in my books. Don't do it. Say, I can't do it because you're not doing it right. I know you're not doing it right. And this is one of those moments where you have to kind of stand up to your client and say, you're going to have to do this correctly or this whole thing crumbles. And if we don't do this right, the IRS can come back and revoke our S-Corp election because we're commingling business and personal assets, and you'll pay self-employment tax on every single year that you are an S-Corporation because they'll go back as far as they can. So we're going to scare them and say, you got to do this right, and I'm not going to put this stuff into your tax return if you don't do it right, okay? So let's talk about the billing. If a client wants you to help them with their accountable plan, to teach them about it, to make sure they're complying with it, to answer questions through the year, to offer advice on it, anything, they need to pay the add-on for the accountable plan. Okay, they need to pay for it. It is not something that I publish on my website or the service agreement. It is something that we mention during onboarding. And here's the reason why. I kind of at first, and this is selling science here, I kind of at first want to push them to do it on their own. So in the onboarding, I give them this email, and you guys have it as part of the onboarding lesson. And it's got our plan and the expense report template. And we say that you need to do this going forward. You need to make sure you do this accountable plan. We then also, as part of the onboarding meeting, as part of that meeting that we have with everyone once, it's called the kickoff meeting. Once we're in the kickoff meeting, we mention it again. And we mention it and we say, if you don't want to do this, we have a service we can offer you that does it for you. And that service is $20 a month. And the reason we're mentioning it kind of nonchalantly is if they recognize they're not going to do this on their own right away, then we're going to sell them that add-on right there. But many of them, and I would dare say most of them, actually kind of skip over and go, no, I think I can do that. I think I can do that on my own. Very, very optimistic. And they kind of just breeze through it. So if they choose the add-on, I'm going to show you in the next slide what you're providing them. But in this slide, I want to kind of talk more about what happens for the people that do not take you up on your add-on for accountable plans. For those that don't take us up on the offer, my financial accountants set a reminder in their calendar after the onboard kickoff meeting for the next quarter end. So after our meeting's over with the client with the kickoff and they don't take the accountable plan, the financial accountant sets a reminder for the end of the next calendar quarter to check on this person if they have submitted to us the expense report. What happens is at the end of the calendar quarter, we send them an email that says, hey, we didn't get your accountable plan expenses. Do you have those? Do you have the spreadsheet filled out so that we can book the journal entry for the transaction? And 99% of the time, they're going to say, oh no, what was that? What do you need? Well, there's this accountable plan. You have to submit it to us each quarter. It's got to have the home office. It needs to have your automobile. Otherwise, there's no way to deduct them. And remember, if you can't do it, and this is important, remember if you can't do it, we have an add-on where we can do it for you. But otherwise, we need to have that very soon because we're trying to close your quarterly books, something like that. Doesn't matter. 50% of them at that point will buy your add-on. Okay, that is all that it takes. In the first quarter that you mention it, they realize they're not going to do it. They realize they have no idea what this is. And they say, well, how much is this? And the reason we don't want to have this discussion until later on, I mean, it's fine if they buy it at onboarding kickoff time, but it's just as good if they buy it 3 months later. And here's why. They've already been paying your fee, so asking them for another $20 is not as big a deal as asking for another $20 when they're trying to negotiate the whole package. So it's okay to try and hit them with some of this added, these add-on fees later. I do the same thing with tax planning. I do not try and cram tax planning down them in the first meeting and in the onboard. I wait until the fall and I say, hey, do you want us to take a look at how much you can save on your tax bill? You know, we talked about this when you first signed up, and it's 8 months later. Are you wanting to see how much you owe? You know, that kind of thing. Again, it's better to sell these things later on when it doesn't feel like they're trying to drink from the fire hose. Does that make sense? So each time they say, no, I can do it on my own, we're going to set more reminders. And we're going to make sure that they either send that to us or they don't get to deduct their auto and all the home office and all of these things. See how we're creating a pain point? You see that? We set another reminder, remind them of the pain. Another reminder, remind them of the pain, until all of them decide to opt in for our accountable plan service. Only, I would say at Reagan Financial, my firm, only about 10% of our clients do it on their own. And these are clients who you know the type, they love doing it. They love it. And they're on time, they send it right to us. So we don't have to do a hard sell here. Just let the time and their inability to know what's going on to sell the other 90%. And then 10% of your clients are going to do them on your own. And you just need to do the journal entry. That makes sense? Now, we know how, so this kind of sums up how you're going to keep reminding clients that they're not doing what's required of this compliance, and eventually they're going to add on this $20 add-on. I'm suggesting $20 a month. If you want to make it $50 a month, go ahead. I don't care. I know that $20 a month sells real well, and it compensates me $60 for the work that has to be done quarterly. We've timed it. It takes my folks about 8 minutes of time to make that $60. So that's a pretty good return on investment, right? Once you get these things organized and you have several, hundreds of clients doing these, your employees become very, very good at them. And they mostly have most of it filled out except for maybe mileage and a few variable things. So it gets very easy. Let's talk about what goes into the service when you do sell them, when they do decide to pay you. Let me show you what you're going to do for them. So if you as they start to pay you and you start adding these add-ons, you're going to need to do some work each quarter, really. But it starts with it really starts with trying to figure out what changes each quarter for this client. So you're going to be making the expense reports for them. You're going to be doing that. You're going to be filling out this spreadsheet for them. You're going to be sending them an email each quarter that asks them for the info that goes into the report that is variable, that you can't just slap in there that you know is going to be the same quarter after quarter. Usually, here are the things that aren't the same. It's mileage, house repairs, fuel, car washes, auto repairs, anything out of pocket. Those are kind of the categories of what is going to be variable. And you know your clients better than anyone. So the things that are going to be variable, you're just going to have a template that is ready for them to respond to you. Out-of-pocket expenses many times are run through the business accounts anyways. So if somebody's traveling, they may use their business credit card for that, and that's fine. You don't need to move it back over to the accountable plan here. This is just for the things that they actually put on their personal credit card that you're not getting as part of the bank feeds. So out-of-pocket can sometimes be out of there. Some of the home office utilities, things like the internet, cell phone, that kind of thing, sometimes that gets run through the business. That's fine at the end of the day if that's what they're doing and they're paying you for this to make your life a little bit easier. Anything that gets mixed with personal, however, you have to ask them for. When they respond, you'll fill in the blanks of the report, the parts that aren't in there. Tell them how much to transfer. You're going to send them an email of how much to transfer from the business account to the personal account. And all this takes time, right? We're building an app at Halon that's going to manage some of this. And it's complicated. It's more complicated than I wish it was. It it is kind of a strange thing trying to figure out the accountable plan thing. And so in the meantime, you're just going to have to do this stuff by hand. If you follow my $20 a month thing, you will make money at it, I assure you. So it does take a little bit of time. You're going to do it manually. And in the event that the client does not respond to your emails or gets frustrated having to do all of this, there's one more workaround you can do. You can ask them to put all of that spending that they're doing into the business account, okay, like the business credit card or something that you would normally be asking them for. You can say, hey, put it all on the business credit card. And when it comes through the bank feed, you're going to code it to a special shareholder distribution account so that when you do the reports, all the info's there waiting for you. You don't have to ask the client for this information. They still have to send you the mileage, though. There's no way to automate that. So you can't get around that piece of it. But if you start to have somebody get frustrated with this data request every quarter, you can tell them to do something like that. Do as much or as little as you like. Make the service more than $20, as I mentioned before. It's completely up to you. Just make sure if they are paying you that you get it done. Be forceful about the information requests if you have to. They need to comply. And lastly, if you do want to automate the request portion of this, what we do is we set up a quarterly email in MailChimp that goes out to all of our clients that are paying us to do this, and we don't have to remember about the email. So the email goes out and says, we need your mileage, we need this, we need that, we need the other, and that goes out to everyone who's paying us for it automatically at the end of each calendar quarter, and then when they respond to that, we get the information and we put it into their reports. You're going to need some way of tracking some of this. So make sure that you've either got a spreadsheet or you're using QBO to track when they get back to you. Find something that works for you. In our house, I don't have a spreadsheet to show you because that's in our project management system. So when people go into this package and this add-on, we set it up as something that must be done quarterly in our project management system. ProHub is what we call it. It's something I built, so you can't use it. But we put that in there, and if that's not cleared by the 30 days after it's due, then it starts emailing the client, hey, we haven't gotten your information. And that may be a sign that someone's getting frustrated or can't do it, and you may need to go to this other thing where you're setting up a shareholder distribution account for them to run all that through the business so that you have it all. So that is what you are offering. A little bit manual, I get it, but that's why we're making $60 a quarter for 10 minutes worth of your time. You will make money at it, and if you do 100 of these in your 100 client practice, it represents $6,000 a quarter. You know, and for our office, it takes somebody about 20 or 25 hours to do like 300 of them. So we make a lot of money off of this for about a week's worth of work or half a week's worth of work or something. So do it. Let me move on now to the journal entry piece. Let me just move this forward here. In that second tab that I showed you, here's the journal entry. I've kind of taken a snapshot of it. Again, you can make this as much or as little as you like. So if you don't want to just use these 6 categories, you want to break it out across several things, do it. There's no rules that say you can't do that. I just think this is a good option. This is a short option. We're trying to make it as fast as we possibly can. In this example, I've told the client to transfer $3,162.55 from the business account to their personal account as reimbursement for these costs. When that comes through the bank feed, we have a couple of choices. First, we could just book it to shareholder distribution until we're ready to do the journal entry, okay? Because sometimes you may not be ready to do it. But my bookkeepers have kind of started getting to the point where if we're doing this stuff for them, by the time the transfer comes around, we've already got the expense report done because we're the ones who told them what to transfer because they're paying us for this service. So when that comes through, when the bank feed shows this transfer, we're actually just booking the expenses against it. And that's the second option, is you can book the expenses right then, right? So you can do one or the other, doesn't matter. Doesn't matter to Halon or to me at all. For those of you who don't like journal entries, coding the expenses directly against the bank draw is fine. With the vendor, in that case, being the employee. The spreadsheet categorizes everything for you. And like I said, don't make this too complicated. And you can do it differently for each client if you want to. Just make sure it gets done, because if it doesn't get done, that's a huge problem. So let me kind of the last slide here, let me kind of take you through the action plan. In each lesson, okay, in the accounting courses, we'll have an action plan. These are the steps that must be either reviewed with the client or done with their accounting whenever you're doing the books and all their accounting work, to ensure you are covering all of your bases. Okay, so here's the actions to take with accountable plans. Number one, customize your accountable plan spreadsheet so it looks the way you want. Also, use our accountable plan template, or one that you like. You don't have to use our accountable plan template, the actual plan document. You can go find one. If you've already got one, use it. It's fine. Second, ensure you're mentioning the plan in onboarding and emphasizing the details of why and how with them whenever you're doing the kickoff and the onboarding meetings. If you don't make a big deal about this, they will always have a defense when there's a problem with it later that you never told them about it and they had no idea about it and it's your fault. So make a big deal out of it. You know what I mean? Make a big deal out of it. Number three, anytime someone signs up for your add-on for accountable plans, get them on a quarterly communications plan and set up something to track the compliance. Do not have them sign up for this and you start billing it and then all of a sudden you've forgotten about it because you're busy and there's all kinds of other things to do. So make a spreadsheet, use QBO to set reminders, and in that work tab, that project management piece that's in QBO, find something, but make sure you're tracking who's getting this stuff to you. Then anyone who does not sign up for your add-on quarterly, you're going to send them emails asking for the expense reports that they filled out on their own, and when they don't send them in to you, you're going to cross-sell your plan over and over again. Whenever they don't have them ready and you're having to remind them, say, hey, look, I can't be reminding you of this every single quarter. If you can't remember on your own, you need to sign up for my package so that we do it for you. This is really, really important, yada, yada, yada. Right? So make sure you're doing those quarterly emails for those that aren't complying with it. And then number five, never, ever, ever do the work for free. Never, ever, ever do the work for free. Now, there is one thing I will say. If you are doing value billing and the value of, let's say that you're selling someone, instead of on these fixed fees like what I do, where it's based on revenue or something, instead you're selling them the plan of, we can save you $6,000 in self-employment tax, so we're going to charge you $4,000 for that. That's what I call value based. It's based on the value of the tax savings. If you're doing that plan, I could make the case that this should be included. I know that sucks, but I can make the case for that, because if they have to pay you to do other things and they end up getting zero tax savings with the actual compliance that has to be done, not the add-ons for weekly books or payroll kind of things, the things that they could do on their own. If they're having to pay you to, just do the journal entry or something, that's a problem, because for them that should be part of the compliance. I'm not saying you have to offer this add-on for free, but you do need to make a huge deal out of that they have to do these expense reports and get them back to you, or else they have to pay you something extra to do it. That makes sense? And so, but never ever do it for free. Never do any of this stuff for free. Don't just start including it. And then finally, if they do not send you in these reports and they are not willing to pay you for it, hold the line on letting them deduct auto or home office if their automobile is in their personal name. Now let me mention something. What if their automobile is not in their personal name? What if it's in the corporation's name? They still need to track mileage to figure out what the business use is, but you can put that automobile on the books then. 99% of the time, that's not going to be the case. The reason being, and I'm going to get into a lot of this when we do the automobile expense module, which is part of this course that you're in. Most of the time, they are not in the business's name, and they may try and tell you, oh no, yeah, I use it for the business, I put it in the business, yeah, it's in the business, and you say, can I see the title real quick, because I have to make sure on the tax side of things that it's actually in the business's name. And when they show you that it's not, and it's in their personal name, they'd say, hey, you got to do accountable plans. Because putting it into a business name is a huge hassle. It's hard to get the financing for it. It's hard to get insurance for it. It's all more expensive. So the accountable plan is, again, a much less expensive way to go with all of that. So that is the action plan. Make sure you do it as you are kind of rolling out the accountable plan side of your business. And that is all for this video. A little bit long, 50 minutes it looks like, but I hope it was worth it. It's an important piece. It's why we started the module with this, is because accountable plans is something that you really have to get your hands around and start doing. So if you have any questions, be sure to let us know, and I will see you in the next lesson.